Hello, welcome back to the show. So in today's video, I'll be talking about the deepest value stocks in the stock market today. So in today's video, I'll be covering a few things. We'll be covering the deepest value stocks in the stock market, Lilu and Burry's 13F, as well as some questions that you guys have left me in the comment section below. So this is Warren Buffett talking about being greedy when others are fearful. So let's look at this one first.
If you have a temperament that when others are fearful, you're going to get scared yourself. You are not going to make a lot of money in securities over time in all probability. People really, if they didn't look at quotations, but of course the whole world is urging them to look at quotations and more than that, do something based on small changes in quotations. But if you didn't think how much more rational, we've talked about it before, but think how much more rational investing in a farm is than the way many people buy stocks. If you buy a farm, you get a quote next week, you get a quote next month. If you buy an apartment house, you get a quote next week or month. No, you look at the apartment house or the farm and you say, I expected it to produce so many bushels of soybeans and corn, and if it does that, it meets my expectations. They buy a stock and they think if it goes up, it's wonderful, and if it goes down, it's bad. We think just the opposite. When it goes down, we love it because we'll buy more, and if it goes up, it kills us to buy more. Ben Graham wrote about it. It's been explained. But if you can't get yourself in that mental attitude, you're going to be scared whenever everybody else is scared, and expect somebody else to tell you when to buy and therefore get your courage back up or something. I could get this fellow's courage up substantially by saying it's a wonderful time to buy. And then a week from now, he'd run into somebody else that tells him the world is coming to an end.
So as Warren Buffett said, buy when people are fearful, sell when people are greedy. So it's easier said than done because it takes guts to do it. But oftentimes, when you buy the extreme deep, when you buy the extreme fear, it will give you outsized returns over time. So if you're to look at, for example, Meta in 2022. So Meta in 2022, they had multiple different things coming together. So they had Meta's earnings misses, they had regulatory problems, they had the metaverse overhang as well. And then the stock dropped around 75% from all-time highs, all the way until $90 over here. And if you bought the stock at the exact low, currently now you have 7x your money. So it clearly shows that as long as you buy high quality businesses, if the stock drops, you shouldn't be fearful at all. In fact, you should be greedy when others are fearful. Same thing for Netflix as well. So this company over here, it dropped 72% in 2021 after the subscriber dropped. So they dropped in subscribers because all the subscribers, they came in the COVID period, but the markets were irrational at that time. Bill Ackman sold, and everyone is talking about how FANG is no longer FANG. FANG is without N. So it dropped to around $190, and since then it has 5x in price. So what this tells us is when you buy the extreme fear, if it's a high quality business, you will likely get outsized returns over time. Of course, when you're buying it, there is a lot of uncertainty coming in. But if you have the guts to go and do it, then you will likely get outsized returns over time. So in today's video, I'll be covering 3 stocks that are facing this issue right now. So the first stock is none other than United Health. So United Health over here in the past month alone is down around 52%. It's quite remarkable for Dow Jones company to be down this much. And currently it's trading at an 11 times earnings. So if you have to look at the mean forward PE, for example, the mean forward PE is at around 18 times earnings. The mean PE is at around 20 times earnings. And the mean dividend yield for this stock is at around 1.7%. Currently now it's trading at a dividend yield of around 3.04%. So it clearly shows that this stock is extremely undervalued. So for United Health over here, here are some of the risks when it comes to the business. So number one is the regulation risk. So PBMs could be removed in the future. Trump has said he wants to cut the middleman out of the healthcare system to reduce the cost on all the consumers. The next portion is simply just the fraud problem. So there's Medicare fraud that's going around, and although the company has denied it, it could be true that United Health has been committing fraud. So CVS and Humana had similar issues as well, and they were just merely fined. And for United Health over here, Medicare only makes up around 15% of the revenue, and for the stock to drop down around 52% for this 15%, it clearly shows that there's some form of irrationality over there. Next risk when it comes to owning this stock is that no one can truly understand the business unless you work there, and there's cost structures in play as well that no one is aware of. So unless you're someone working at United Health, you won't truly know the risk of underwriting all this insurance, and so it's a bit hard for you to judge if you're outside United Health buying into this stock. As for United Health's tailwinds over here, here are some of the tailwinds. So they have the Medicare premiums that will be likely revised higher this year with Medicare bids coming up soon. So the CMS, they basically revealed that your Medicare Advantage prices will increase by upwards of 5%, and they announced it a month back. And there's another tailwind as well, which is Trump capping all the different drug prices. So when Trump is able to cap all these drug prices, this will drive down costs for all your insurance companies. And for United Health over here, normally the big companies, they get away with a lot of things. And if you're to look at the history itself, for example, Boeing is currently facing a lawsuit with DOJ, and the DOJ is likely to just give Boeing the free alley and the freeway. So for United Health over here, the government needs them. And so if we were to have a lawsuit between United Health and the government, it will likely just be a fine. There won't be any actual consequences for this company over here, real consequences. So for United Health over here, if you're to look at the valuation itself, so assuming a 21 EPS this year, so the EPS last year was around $24. So let's say the EPS drops around 15 to 20% to $21 over here, and assuming a 17 times earnings for this company's mean PE is usually at around 20 times. So assuming it goes back to only around 17 times, and assuming an 8% EPS growth for this company, with a 3% dividend yield, this company will give you a 16% CAGR over the next 5 years. So it clearly shows that this company is extremely undervalued. The company is looking to get long-term EPS growth of around 13 to 16%. So this is likely a lot lower than expected. And then if let's say you increase the EPS to around 10%, then this will give you around an 18% CAGR for the next 5 years or so. So this clearly shows that United Health is extremely undervalued, and that's why I've been adding to this one. I don't know the extent of all these regulatory problems, and so it's a bit hard to judge. That's why it's only a small position. So for United Health over here, anyone buying this stock needs to acknowledge the fact that they can never truly understand the business. The stock is deeply undervalued right now, and even with low estimates now, the stock seems really cheap. Fundamentals are still strong as well. This could be a Netflix and Meta all over again, where one good report sends the stock flying again. So the sentiments are extremely crap right now. They had multiple different news articles coming in at the same time. So this is typically the worst case scenario already. So apart from being sued for fraud, this is probably the worst case scenario for United Health already. And so I think for anyone buying into this stock today, the upside is definitely better than the downside over here. Next stock is Alibaba. So Alibaba over here is currently a company that's trading at 16 times earnings, and year to date is up around 45% or so. So for Alibaba over here are the risks when it comes to owning this stock. So number one is your China government intervention as well as tariffs. Number two is your Chinese consumer risk. And number three is continual deflation of Chinese goods, which will hurt Baba's earnings. As for Alibaba over here, they just reported their earnings, and if you're to look at the earnings itself, I think the earnings were quite remarkable. So the China consumer retail, they went up by 12% in terms of revenue, and then wholesale retail as well came in at around 17% higher. So total Taobao and Tmall came up at 9% revenue growth. And then the cloud business, which is this portion over here, grew 18%. So it clearly shows that Baba is trying to transition from just a retail company to an AI company as well, and a cloud computing company. It's the biggest story of this company right now, and they are heavily investing into it. So Alibaba stock went down around 8% 2 days ago, simply because the free cash flow was a lot lower than expected. So they're heavily investing into cloud computing right now, and they're projected to spend around $37 billion, I believe, over the next few years or so on cloud computing over here. So for Alibaba, I think it's a company that has the AI tailwind pushing it. And in the Chinese economy over here, Alibaba has the biggest cloud computing software out of all the different cloud companies over here. As for Alibaba's valuation over here, so assuming a 10% EPS growth and a 17 times earnings, this will give you around an 11% CAGR. And if you're to assume, let's say, a 15% EPS growth and a 17 times earnings as well, this will give you around a 16% CAGR. So it varies over here. It depends on how much growth you put on this business. So this business is currently giving you around a 7 to 8% revenue growth. And assuming a 3% buyback and a 1 to 2% margin expansion, this 15% is actually doable. In fact, this year alone, they grew their EPS by upwards of 100% from last year already. Last stock is Novo Nordisk. So Novo Nordisk over here is down 4% today because their CEO just stepped down, and this company is a company that's trading at 18 times earnings today. So for Novo Nordisk over here are some of the risks when it comes to owning this stock. So they have competition with Eli Lilly. They have the drop pattern maturity in 2031 as well. They have regulations and tariffs on pharmaceuticals, margin compression as competition on price increase, as well as the drug cap that Trump just introduced as well. As for the tailwinds for this business, you have the lowest valuation in almost a decade. So currently now Novo Nordisk is trading at around 18 times earnings, and he has never been this low in almost the past decade. Next tailwind is simply just the weight loss drug, projected to grow around 20% each year all the way until 2030. So Novo Nordisk is the market leader in your weight loss drug category, and it will likely continue compounding with your weight loss drug industry over here. Last one is just the increased distribution by having deals with Hims and Hers as well as CVS. So what Novo Nordisk is trying to do is trying to increase the volumes for the products itself by introducing all these distribution networks to Hims as well as CVS, all while reducing the prices. I think for Novo Nordisk over here, it's a smart move. Given their patent is already expiring, they need to increase the volumes so that they can remain the market leader in the industry over here. So for Novo Nordisk over here, here's my valuation spreadsheet. So assuming a 13% EPS growth, the weight loss drug industry is projected to grow at around 20%. So I believe 13% is extremely doable for this business. And assuming a 17 times earnings, this company will give you around a 13% CAGR over the next 5 years. And let's say if you're to assume a 15% EPS growth for this company over here, and again a 17 times earnings, which is the lowest in the past decade, this company will give you around a 15% CAGR over the next 5 years. So it clearly shows that Novo Nordisk is undervalued as well, similar to Alibaba, similar to United Health over here. Next portion, I'll be talking about Li Lu's as well as Michael Burry's portfolio. So Li Lu over here, he's Warren Buffett's understudy. His name is the Chinese Warren Buffett. And so in this quarter, he reduced a lot of his positions. I don't know where his funds are going to. But he sold 23% of Bank of America. He sold around 19% or 20% of his Google stake. And he sold majority of his Apple as well. So I agree with this Apple sell. Apple is a company that has a hefty valuation right now. And he's just following what Warren Buffett is doing, selling out of his Apple stake. As for Google over here, I think he is weighing in the risk of Google search being disrupted, and that's why he's reducing his stake. But he still has around 34% of his entire portfolio in Google over here. And for Bank of America, he reduced his position by around 23%. So he is also doing what Warren Buffett is doing, because Warren Buffett has previously said that the banking sector might be facing some form of problem soon because everyone is over leveraged in this sector. So for Li Lu over here, I've been paying close attention to his portfolio. This portfolio over here is just simply a high quality one with concentration into just a few stocks over here. Next portfolio is Michael Burry. So Michael Burry, he sold out almost every single one of his position over here. He's a contrarian trader, and what he does is he flips his portfolio almost every single quarter or so. So he sold out of almost every single one of his position, and he bought Estee Lauder over here. Estee Lauder, if you don't know what they do, they sell their beauty products, and over the past few years, the stock price has been decimated. So it went down from around $300 to $400 down to around $60 at its current stock price. And for Michael Burry over here, I believe he bought a lot of puts on the stock market and he likely exited out of it already. So for Michael Burry over here, I think his activity is extremely hard to follow. He's a trader by heart, and that's why I don't think his investment methodology is suitable for anyone that's trying to get into investing over here. Last portion, I'll be talking about some questions that you guys have left me in the comment section below. So the first one, it says Seth Klarman adding Google is a big indicator that it is undervalued. So for Google over here, yes, the stock price is undervalued, and yes, Seth Klarman added into his position last quarter. In fact, he added around 50% of his Google position. So for Google over here, yes, it's a company that is extremely undervalued, but it is worrying to see other super investors like Chris Hohn, like Bill Ackman reducing their Google stake. They likely know something that we don't. And for Google over here, I'll be talking about it in a video soon. But there are risks associated with this company over here. Next question, are you invested in Grab? So Grab is a company that is super big on your ride hailing in Southeast Asia as well as your food deliveries. So in Singapore, for example, Grab is the biggest one here, but there are competitors in this space as well. Like in Singapore, you have Tada, you have Foodpanda as well. You used to have Foodpanda, but I think Foodpanda was bought over by them as well. And then you have other ride-hailing companies coming up in Singapore as well. So for Grab over here, I think it's a company that is not super predictable. Of course, if you're investing into this stock now, you're betting on the ifs. You're not betting on the predictability. You're not betting on what they already have. You're betting that they can revolutionize and turn Grab into something that isn't already here. And so for me, I don't feel comfortable taking the risk in investing into Grab. I mean, I don't really think Uber has the moat to basically stay here for the next 10 years or so. Neither does Grab. And the current valuation now is still quite high, and it just turned profitable, I think, last year as well. So for me, I think Grab is an avoid. Next one over here, thanks for answering my question. Reddit, Rivian, Airbnb may be interesting US stocks to study if you haven't already. All three have huge growth potential in upcoming years and months or so. None of them feel extremely risky. So Reddit is a company that is risky in my opinion. So they have around 10% of their revenues coming from Google, and they highly rely on Google for their search results over here. So for Google, they have a deal with Reddit whereby Reddit will basically send their data to Google for algorithmic training, and in return, Google will place Reddit ads higher up as well, and then Google will also give Reddit some form of revenue as well. So for Reddit over here, it's a company that just turned profitable. So for me, I don't think I'll be investing into it. I think the highest quality social media company out there is simply just Meta or Google. And so for me, I think Reddit is an avoid over here. Next company is Rivian. So Rivian again is a company that is in the automotive space, and the automotive space has high competition. So for example, you have companies like Tesla, BYD as well. I think BYD and Tesla are much better investments than Rivian over here. And so I don't think investing into Rivian is a smart choice right now. And so I'll be avoiding this one. As for ABNB over here, it's a company that I've looked at. But the problem with the business is it faces too much regulation. And in Singapore, for example, in my country, this country doesn't allow any form of Airbnb. So in cities like New York, they have considered removing Airbnb as well. And so I think Airbnb, the better alternative to this stock is simply just to buy Booking. Booking is a company, it's a compounder. If you're to look at the fundamentals itself, the company is just way more structured fundamentally as compared to Airbnb. Booking doesn't have a very substantial moat, but the fundamentals are a lot better than Airbnb over here. So for Airbnb, unless it goes down to a cheap enough valuation, I don't think I'll be considering this one anytime soon. Hopefully you guys have found this one useful and invest safe.